All right, folks, here's something interesting, and it's another way to go about looking at things. Okay, so to put things in perspective, saving 5% of your income means you'll work for approximately 66 years before you achieve financial independence. All right. Now, that's not a prediction. That's based on math. Okay. And most people have no idea where their savings rate actually puts them. We've heard over the years that folks should save 15% or 20%, but there's been nothing beyond that point of as to why or where that number comes from. So this might put some things in perspective for you. Okay. Now let's go through this, and here's what the data looks like and the assumptions it's built on. All right. So to hit these numbers real quickly, all right, the numbers assume a 5% real annual return. What that means is that's just another way of saying the rate of return after inflation is factored in. So let's assume we have an investment that returns 8% year over year, and inflation is running at 3%. That's where a 5% real annual return comes in. Okay. Now, it also assumes you can safely withdraw 4% of your portfolio per year in retirement. All right. Now, this is based on the 4% rule for those that are familiar with that rule. That rule basically says that if you withdraw 4% of your portfolio per year in retirement, your money should last. Okay. Now, nowadays, where people are living longer and retirements are stretched out longer over a longer period of years, there's been some debate around whether that's the right number or not, and that's fine. We're not here to illustrate, uh, um, the 4% rule and how it relates to everybody's individual situation. We're just here to illustrate a point. So, if we were using the 4% rule, that means you need 25 times your annual spending saved before you stop working. Okay. So it's just another way of looking at the 4% rule. All right. Now that's the model. Now here's what it produces on a high level. And I have some data here that's not in the chart. So if you want to listen in case I fire off a number that's more relative to you. But remember, we're looking at a 5% real return here, and this is what the data shows. All right. Now, better returns can get you there faster, and lower returns can take longer. But when we stretch out returns over a long period of time, I believe these are truly realistic numbers. Okay. So at a 5% savings rate, which would actually be that top bar there, all right, like I mentioned earlier, you're looking at the 66 years before your portfolio can replace your income. All right. At 10%, that'll be the second bar there. You're looking at 51 years before your portfolio can replace your income. Okay. All right. Now, so what I'd be doing at this point in time is I'd be looking at your age and then your savings rate. All right. And let's say you're a 30-year-old. Okay, and you're saving 10%. Okay, and you just started saving 10%. Okay, you're looking at by age 81 is when your portfolio would be able to replace your income. Okay, so it gives you an idea of where you stand. All right. All right. At 15%, okay, which is what we hear a lot of in today's world. And I think this is where why we hear a lot of it is because let's look at a 22-year-old who's saving 15% annually. All right, so 22-year-old fresh out of college has just begun working. They're saving 15%. That's a 43-year length of time before their portfolio can replace their income. Okay, so do the math. 22 years old, add 43, you're looking at 65. Maybe that's where that 15% is coming from. Okay. At 20%, we're going to drop down to that line there with the 37. Okay. At 20%, you're looking at 37 years. Okay. And then look at what happens as it further climbs. At 30%, all right, we're looking at 28 years. And then at 40%, you're looking at 22 years. And at 50% down bottom there, all right, you're looking at 17 years. Okay. And then the math just goes beyond that. Okay. But another way of looking at this is if you go from saving 10% to saving 20%, all right, that cuts 14 years off your working life, all right. Also, if you go from 10% to 30%, that cuts 23 years off your working life, okay. So it just helps put things in perspective, all right. All right, now most people focus on returns, okay, which is completely fine. But when they focus on returns, they're thinking, which fund do I pick? Which stock do I pick? Which asset allocation? All right, which investment? And returns matter. They do. But because if you earn more than 5% real rate of return, you get there faster. All right. If you earn less, it takes longer. All right. But here's the thing: your savings rate is the dominant variable early on. All right. You can't invest your way out of a low savings rate. And that's a concept that's hard for folks to understand, but it is a hard truth that they should realize is you cannot invest your way out of a low savings rate. All right? And this is what most people miss, okay? Your savings rate isn't just a discipline problem. It's a structure problem. So most people don't know their actual rate. They're really not tracking it. Okay? They're saving whatever's left at the end of the month. Okay? They may select a percentage, in their 401k and never forget about it, but that's sometimes that's not a true reflection. All right? Um that's not really a system. That's right. So when folks are saving whatever's left at the end of the month, that's not a system. All right. Now, here's what people miss. Okay. Your savings rate isn't a discipline problem. All right. It's a structure problem. Okay. So most people don't know their actual rate. All right. They're not tracking it. They're saving whatever's left behind at the end of the month. Okay. Now, that's not a system, that's residual. All right. And so, with that said, a managed system, okay, sets your savings rate intentionally. Okay, it puts those dollars in the right accounts so the growth is as tax efficient as possible. All right, and does it constantly, not when you remember to. Okay, so that's the difference between hoping the math works uh, and knowing it will. Okay, all right. Now, if this is something that relates to you, you can book a 20-minute virtual with me directly. The link is in the description below, or you can head over to zenfp.com. There's a link on our website there. But with that said, until next time, folks.